markets came into this year incredibly excited that this was going to be a big year of easing monetary policy in the US. Maybe yields coming down 1%, 1.5%, 6 or more rate cuts. And the Fed, given what's happened in the last few months of inflation prints, with core CPI looking to settle around 4%, demand-driven services inflation, which are really important, even higher than that, it's looking a lot harder for the Fed to deliver on investors' hopes. And so given that you've had this great run in markets, it does seem like there's scope for some of that bullishness to just, in the short term, be unwound and for this sell-off to go a little bit further, despite the medium-term picture still being, frankly, very good.
I think investors are also asking, can we trust this Fed? Lagarde says she's basically ready to go. Bailey says he's basically ready to go. Do you think the Fed's losing credibility here or losing control of its own narrative?
I think the Fed has always been quite clear that it's data dependent. And while the inflation data was modestly encouraging towards the end of last year and did suggest that there was room for a number of rate cuts this year, they've reassessed the data as it's come in. Obviously, data is volatile. We'll see what happens in coming months. But I think they've maintained their credibility by taking a step back and saying, we have room to wait a little longer. And actually what makes their job arguably a bit easier in the US relative to Europe is that strength of the US economy. You know, both the strength of the consumer and this pickup in inflation suggests that they should be just reassessing that rate cut outlook, whereas in Europe, there is more of a focus on the relatively weak growth outlook and whether they need to support growth regardless of what happens to inflation.
Right, and so much to ask you here, Ian, but look, I think we can maybe push it forward by asking about the market opportunity. 4.6% on the 10-year on that inflation fear, perhaps giving equities a run for their money as well. At the same time, around 106 on King Dollar, which is having a profound impact elsewhere. So where is the opportunity right now as we see valuations being adjusted lower stateside?
So I think short term, one of the best positions to hold is that US dollar, not just as a safe haven if markets do sell off a little bit further in the near term, but also as an expression of rates likely being higher in the US relative to other markets, and there's more for that tree price, and as a reflection of the US economy being particularly strong in a global context. So we are looking to be patient, to kind of buy this dip as it unfolds, and it's a case of seeing what's on your buy list. And so within the Asian region, and Asia has been hit harder than say US and Europe so far, you know, there's areas of India and Indonesia, particularly the banks, where we see a great structural growth story. And then looking kind of stateside, US mid-caps offer a lot of value, and again have been one of the first things to get hit, and so we would be looking to buy that. But for now, I'm feeling a bit more neutral, waiting to get a good opportunity to buy this dip and reinstate that bullish outlook that we had.